G'day traders, Greg McKenna here. I want to talk about Fibonacci levels today, but I'm going to call this episode Lecturing Birds on Flying. And the reason I'm going to do that is because there's been a little bit of Twitter debate and some Twitter feedback that I've been drawing my levels in the wrong spot. Now what I want to do is I just want to discuss how the 38.2% retracement of any move is actually the 61.8% level of that move. So when I'm talking about these things, they're interchangeable. Now, of course, if you're an Elliott Wave-ian and you're using that, when you're talking about a 38.2% retracement or a 61.8% retracement, they have important and material impacts on what you are thinking the next move could be. But when I'm talking about a 38.2 or a 61.8, I'm just talking about them from a Fibonacci retracement kind of level. And as I said, the 38.2% retracement is actually the 61.8% level of the move that we've just had. Now I want to use the Aussie weekly chart and then drill down to the dailies to show you how we can discuss them, how we can draw them, and how important they are. Now just a brief bit of history. When I first started trading, I was a fundamentalist. Now I started back in 1988. And you learn all about economics and all that kind of stuff, and you think about what's happened overnight and what's that going to do for interest rates as I was then, or currencies or commodities or that kind of thing. Now, I was a fund manager at State Super when the Asian crisis hit, and I had started doing technicals over the previous few years. But I wanted to do a test. I wanted to see just how well technicals work, and in particular, I wanted to see how well Fibonacci levels work. There's something mystical about Fibonacci levels. I've got a copy of Leonardo Paisano's book, Liber Abaci, here in my office. And what I wanted to do was I wanted to see if they work. So when the pegs broke for the Malaysian ringgit, the Indonesian rupee, those kind of things, I started drawing Fibonacci lines on those currencies literally from the moment they broke. And surprise, surprise, or unsurprising to anybody that's traded for a while, they worked really well. So I think Fibonacci and Fibonacci levels are a really important part of anybody's toolkit. The Aussie shows a really good reason why that is. Let's have a look. So the weekly chart here. Most people would agree that the recent down move started around September, October 2014, and after bottoming around the 69 odd level last year, had what you might call a double bottom perhaps this year. So what we've got is we've got this move here. Let's blow it up so we make sure we get the levels in the right spot. Got this move here going down to there. And what we see, if you think about what I was talking about, right? So this is the move. It's a down move from around 93 cents down to around 68.5, give or take. And then we have the retracement levels. So the retracement level for that big move was around the 78 cents level that we've just seen as our peak. So that was one of the things with my trading, and I think most people's trading these days, is that once you've had a big move in a currency or a commodity or a stock, you tend to think that there's a real chance that you're going to get either a time or a price consolidation. A time consolidation is when the market goes sideways, like it did in 2014. And a price consolidation is what we've just seen in the Aussie, a rally from mid to low 68s to low 78s, a rally of 10 cents. But interestingly, from a Fibonacci point of view and from a trading point of view, what that also did was it came back to the 38.2% roughly of that big move. So what does that tell me? That tells me that's a good place for the move to pull up. We've seen that before. I tested it with Asian currencies when they first were depegged back in the late 90s. And then we've had a turnaround. So you can see that level there. But if I change down to the daily time frame, what we do then is we draw our Fibonacci's from this high here back to this low. Now, of course, you could, and you probably should, draw it because it's an up move from this low to that high. But the reason I purposely did it from high to low was to show that there really is no difference between the 61.8 or the 38.2. Now the reason I raise that is I've been getting some feedback on Twitter that I'm drawing my lines or saying the wrong levels. traders, it makes no difference. 100 minus 61.8 is 38.2. 100 minus 38.2 is 61.8. The 38.2% retracement of a move is the 61.8% of that move. They're interchangeable. Get used to using them interchangeably because it's the level that's important. It's the fact that other traders are watching it that's important. Now, I raise this point because I've been getting the feedback, and it kind of concerns me that people are maybe worrying too much about the minutiae of what they might call a move than actually what the opportunity that move offers. And as you can see in this chart here, the peak was in a perfect spot. 38.2% retracement of the big down move is roughly where it topped out. Now, if you read my stuff, look at AxiTrader, look at my website, you'll see that we talked about that then. So what have we got now? Now I've been talking about the move lower. Of course, I've got trend lines. I always use trend lines. This is not my system per se. This is the tools I use as part of my system. But you can see these trend lines when they break down, then we get targets. And the first target, of course, when we bounce off such a nice level, was the 61.8% move, which is the 38.2% retracement, which came in around the 74.50 region. Right. When that bounced off that initially, the Aussie got back to, I think it was 76.30 or something like that after the initial bounce, and then it broke down again. So then the next target becomes a 50%, and no one can muck up the 50% because 50% is just half away. But now we've broken, and the target is the 200-day moving average. So you can see how where I'm putting all these things together, but the key here is these Fibonacci levels. A garden variety pullback after a big move, and a 10-cent move is a big move, is to expect it to come back 38.2% of that move, which in this case was 74.5, roughly. 74.45. Now that's one of the reasons when I do my videos and those kind of things each morning, I talk about a lifestyle short, and I took that lifestyle short above 78 cents. Now, where the Aussie goes from here, 200-day moving average around the 72.40-50 region, and then the last line of resistance, which is the 38.2% of the move, or the 61.8% retracement of that move, is around the 72 figure 10 region. Now, I want to show you something else. This is the power of the old Fibonacci levels. Now, you can see I'm starting to muddle up my time frames here. I've got my weekly time frame, my daily time frame, but I just want to put a little bit of a bigger picture in here as well. If we say, so this is a time consolidation. If we say the actual Aussie move started back here in 2013 when RBA Governor Glenn Stevens got out his jawbone, and we have a look at where things went, then you can see, I'm just going to change the color of that to purple. Sorry. Let me, Murphy's Law, ladies and gentlemen, I'm sorry about this. Murphy's Law wouldn't be a law if it wasn't true. All right, but what you can see here is that there's another rung down. I mostly only use 38.2s, 50s, 61.8s, and then 138 as an extension once you take out the top. That's one of my favorite trades, is rally, pull back to 38, or somewhere between 38 and 61.8, and then a move back through the high for a projection to the 138% of the previous move. But a lot of people like to use the little ones, which are the 23.6 and that sort of stuff. And the 23.6 for this rally came in around the 78 cent region. That's the 28. That is the 23.6 of the move back here. If I could pick that up and move it, there we go. Now you can see it properly. It's come in. There's all this convergence here in this high 77, low 78. So that's another reason how I use Fibonacci's, or another way that I use Fibonacci's is I bring them together multiple time frames. So hopefully in this short video, although 9.5 minutes isn't that short, hopefully in this short video you've got a feel for how I use Fibos, and also a feel not to get too constricted about whether it's the 61.8 or the 38.2. They are the same, and they both are the primary important levels for Fibonacci traders. They're the ones that traders watch. So good luck with your trading. None of this is recommendations, obviously, and there is a chance of significant loss when you're trading leverage Forex or CFDs. So be careful, and whichever broker you're using, have a look at their PDS and make sure you've always got your risk controls working and under power. So that's it from me. Have a great one, and I'll be back soon with another video. Bye for now.